So we're here today in the Devonshire Club in the City of London, and I'm here with Leon Boros. Leon, tell us a little bit about you.
I'm a chartered accountant by training. I trained with Ernst & Young, an economics graduate. And after leaving Ernst & Young, when I was 29, I set up a corporate finance practice. And I still do corporate finance today. It's typically helping quoted companies buy private companies. But I combine that corporate finance work that I do with private investing.
And I gather you've had a tremendous year to date. What return have you got?
Well, across all portfolios, it's around 44%.
Gosh.
And in my ISA, it's 48%.
Gosh. And is that typical? I think you've been investing for, 25 years. What sort of return do you normally get on average?
The best I ever did was in 1999 when I was up 88%.
Wow.
And I was up 53% in 2013 across all portfolios. But the IRR, since I started within my ISA, that was 25 years ago, that's at I'm exaggerating, it's 19%. And then if I conveniently forget those down years in 2001 and 2 and start it from 2003, then the IRR since then has been 22.3%.
And what do you target? What makes you, I mean, obviously the bigger the better, but what makes you happy in terms of what your target is?
I suppose in my mind I think 12 to 15%, but I never think of that as an annual target. I mean, I frankly don't know what's going to happen tomorrow, let alone next year. And I think, especially after this very strong run we've had, it would be ridiculous to assume that I could generate a mid-teen return next year. But I tend to take the view that over the medium term, whatever that's defined, then I'm confident of being able to beat the FTSE and deliver something in the mid-teens.
And the longer you do it, does your return improve, or is it very market related?
How do you disconnect the two? But certainly if you look at the results since '03, they have been better than the results from 93 to 2003. I managed to sidestep the financial crisis in '08, so that's helped my returns significantly. But we have had some very, very good years of late. So, I think it's probably the IRR, from an IRR perspective, I would be amazed if the IRR was still at that level, rolled ahead one more year.
And how did you get the premonition to avoid the 08 crisis?
I think it was partly down to luck, if I'm being honest. I was uncomfortable around March '08. The market was very volatile. There was a lot of noise about the credit crisis. I started reading into it. I can't say I became more of an expert after the crisis than before. But nonetheless, I took the view that the markets weren't pricing in the risk. So I sold out within my ISA, I sold everything in March '08. I did keep Autonomy, you might remember that stock, within my SIP. That was luck rather than anything else, because that actually did well during the financial crisis. But I sold almost everything, really, probably 85-90% of what I had. And then I stayed in cash until March '09.
Gosh.
But I was a bit tentative coming back into the market. So I timed the bottom right, but I wasn't as aggressive as I should have been in '09.
In March '08, it sort of worked in a band. Did you get out when it was sort of tanking down, or was it when it blipped back up?
No, it was when it was tanking down,
Yes.
to be honest with you. So, soon after selling out, of course,
it blipped back up
It
a
blipped back
bit.
up again. I looked like a bit of an idiot. And I've never sold out completely or to that extent before. But by October, of course, I was rubbing my hands.
Absolutely.
And it was nice because I didn't have to go through the stress that so many other people had to. But also equally, it reminds me that, that stress, that type of stress is not nice. I went through it in 2001 to 2003, early 3, where my portfolio dropped from probably about 50-60% over that period. So, if
that was a more difficult time because it took a lot longer to recover.
That's right, and it was more protracted. So it was a 3-year bear market before it recovered. But it's good to go through those experiences. I think, I'm delighted I didn't start investing in 2009 because I would have only known of good news.
Yes.
And would have
so
been
this
complacent.
year you've got 44% return. Have you got any cash? Or is that fully invested?
No, I very rarely am fully invested. So my cash levels will sort of flux between about 20% and 5%. At the moment, they're just a tad under 15%.
And you don't think that's expensive if you can get 44% return on that 15%, is it?
Yeah.
Why do you have it in cash?
I suppose it just gives me flexibility, and I don't have to think about selling something if I want to buy a stock. I suppose it makes me just feel comfortable having some cash for a rainy day should I need it. And I suppose it's a barometer of where I am in terms of sentiment. So so at the moment it's sort of towards the top end of the range that I normally keep in cash.
And has the 44% been achieved through a mini type trading, or is it buy and hold?
Yeah, so generally I'm a buy and hold player. I ploughed through the Minervini book and thought I understood it until I started trying to implement some Minervini strategies.
Did it work?
No, of course it didn't. And I have to say that if I'm probably a loser when it comes to trading. I reckon if I look over 15, 20 years, and I've learnt actually as time goes by, is to actually keep my trading type things down to the bare minimum. So it gets the gamble out of me without affecting my overall performance. But I think in terms of momentum stocks, I've done very well with Boohoo, which I picked up at 28p, sold most of it around 220, something like that. So that counts as a Minervini stock, arguably. I've been buying Fever Tree. After I sold down Boohoo, I started picking up Fever Tree, and I've been buying back on all the, it's been quite weak recently, until today, actually. It had a trading update, which was good news, and the shares are up. But generally, my portfolio doesn't have too many. They're stocks that might become momentum stocks, but they never set out to be momentum. So Bioventix falls within the definition of a momentum stock according to FinCap. It's part of its more momentum portfolio. But to me, I don't think I think of momentum as being things which may not have great underlying characteristics, but are just being bought because it's flavour of the day. So
would you put IQE in that category?
Yeah. Yes. I've owned IQE, and in the past I've owned it quite recently and made a profit on it. That was a trade. But I can't get past the fact that it's still a foundry business and that it needs to invest huge amounts of capital. It's never made much of a return over its entire history on the stock market. And of course, it's now reliant on VSCL, or I can never remember how to.
Yes.
And it may do very well, but I haven't invested the time and energy, honestly, to get to fully understand the story.
So in order to get 44% return, what do I have to do? What's your model assessing shares and working out what you're going to buy?
Well, I suppose I look at quality and quality characteristics, so high profit margin, high cash conversion.
What's high profit margin?
Sort of 20% plus operating margin, and cash conversion of sort of 80, 90%.
Gosh.
And then I have various measures I use for return on capital, whether it be return on equity or return on total assets. And again, I'm looking for higher return businesses. So, to be fair, the last few years have paid quality investors handsomely.
Yeah.
And we've seen that with the Fund Smith portfolio and how well that's done based upon bigger quality stocks largely in the US. But I think that gets me in a lot of danger. So I tend to avoid problems where I'm going to have either a complete write-off or a partial write-down. I do have losses, but I tend to avoid too much trouble. So in terms of is that a viable strategy to make 44% next year, I frankly don't know. It could be commodity stocks, so the oil prices have just hit a recent high. So it could be some other thing. But I'm inclined to think that I'll stick with my approach, and I'll have some good years and some bad. But I think for a private investor, and this is unlike for a fund manager, you do have the opportunity of focusing on your best ideas. And and I've not been shy in putting my money forward where I become very convinced about a story, and it has to be much more a story. It has to be a solid opportunity with limited downside risk. I will put a lot of money. At the moment, My largest position is 30% of my portfolio, second largest 10%. I've got about 40 stocks in my portfolio. I'm down to about 2% on my 11th holding. But the point is that when I see an opportunity, I really go for it. And that can help returns. And that can help returns even when the market isn't doing very much. So there's always going to be some stock that is doing well. And if you happen to be in the right ones and you've charted the course to make sure you are in the best stocks, then you can do very well.
So will you start off with the 1 or 2% in your portfolio? Are they the ones that go on to be the 30%? Or how do you...
Yeah, so sometimes they'll start as a relatively modest investment, probably even less than that. I think probably I started around 0.25% to put my feet in the water, get to know management better, and also as a catalyst for me to do further research as well. But sometimes if a good idea comes and I absolutely like the stock and the downside risk is mitigated, then I'll go straight in with a large position.
So you've given us some financial metrics that you use to select shares. Beyond that, what are you looking for?
I'm looking for honest management. I place a huge reliance on the quality and the honesty of on management.
How do you judge that?
Well, it's a tricky one, but I think I am quite, I get in front of management, so I try and either at events organised by ShareSoc or indeed events that the Private Investor World organises, and that gives me a chance to see how they perform under some pressure, because private investors hate losing their money and will tend to ask very good, perceptive questions. But also I'll arrange private meetings with management teams. I tend to like to go with other people, so I tend to lob in the hand grenades, the difficult questions. Other people might be taking notes, but I'll then focus on how they answer the question. I'll pay. The more money I've got invested, the greater I focus on how they're answering it and what they're saying and all the non-verbal tells that they're giving away. And I think it has protected me hugely from some disasters. I remember the day I discovered Bioventics. It was Gervais Williams presenting at a Mello event. A company called Silverdale presented with a very charismatic CEO. I loved what I heard about Bioventics and subsequently set up a meeting and really liked management. I didn't quite feel comfortable with the Silverdale chap. I do know of someone who put all their money into Silverdale, or a lot of their money into Silverdale that evening, and lost it all. And and I've made a considerable amount of money choosing the other horse. But it shows you also how investing can be. You are literally, you don't know where the next minefield is, so you've got to be very wary, because no matter how well you've done in the past, you can make a mistake. But I'd like to feel that being perceptive about management is one of the strong points, combined with the financial analysis, etc. In terms of other things I look for, I want to see a business model that's growing. I want to see something that is durable and has moats, to use the Warren Buffett phrase. And I'll tend to look long term. So I'm very poor at thinking, well, this company is trading at £1, but I reckon it could be worth £1.20. I'm very reluctant to get involved there for a 20% gain. I'm looking for ones. My mindset is I'm looking for the 5 and 10 baggers. I'm looking for ones that I can hold and that can compound. And I've found even from my own portfolio that you just get a few multi-baggers and they pay for all of your mistakes.
So you've covered off some of the key criteria. What sort of shares, therefore, fall into those criteria? What are your top picks?
Well, the ones that fit the criteria are shares like Bioventics. XL Media is another one. Very high returns on capital, good profit margins.
Doesn't bother you that it's Israeli?
A little bit, but they are, they're a phenomenally resourceful and creative group of people, and the Israeli companies are world leaders in that area. And I think that a lot of the Israeli stocks are dealing with the governance issues in a much better way. And certainly, I've got no real risks with XL Media.
Culturally, when you meet management and they're of a different culture, so Israeli or from somewhere else, does that make it more difficult to judge honesty, personality, integrity?
It can be a little trickier, but I think in some ways it's in sharper relief. They haven't got necessarily the English polite screen to or saying one thing but meaning another to hide behind. So in some ways it's easier, I find. And then some of the companies coming to the AIM market, you have to question why they're coming to AIM. All the Chinese companies that came, and almost every single one of them turned out to be a fraud. But I think that in relation to the Israeli companies, that many of them are world-beating companies, and I'd like to see more Israeli companies come over to the UK market.
Interesting. So carry on with your top picks.
So another big one for me is Nintendo, which might seem an odd one, but it was a company that I
American listed.
It's the ADRs, yeah. And the gaming company, Wii U and what have you. But it was a Nick Train idea I picked up about 5 or 6 years ago. They were trading at that time at close to cash. They had a strong brand, strong portfolio. They were trying to find their way in this new digital era. And certainly the last year or so with Pokemon Go and with their new console, they seem to be finding a way through, and the shares have done phenomenally well. I think they're up fourfold since I bought them. Wow. And I bought more in the last year. Another company I've done very well with is Novo Nordisk, again, which ticks all the quality criteria that I set. That company's involved in providing insulin and other products for people who are diabetic.
What market cap is it, roughly speaking?
It's into the billions.
Okay.
It's a good point though, because I realise how little I look at market cap. I'm always looking at relative valuation measures, multiples of X or Y.
So you're not particularly bound in staying in small caps?
No, not at all. In fact, historically, I've probably been all over the size dimension. It's probably only in the last 5 or 6 years that I've particularly focused at small cap.
And other companies?
Now I've got to think.
Well, do they always conform to your criteria?
Yeah. No, inevitably, because of the criteria I set, there's never, I'm always scratching around trying to find companies that fit that measure, because also there's the valuation criteria as well to overlay on it. And in truth, there's probably more stocks in the American market that meet my quality thresholds than in the UK, i.e. capital high return businesses. But the problem I have is that I want to be able to sit down with the people I'm backing, and therefore it's difficult for me to get comfortable, sufficiently comfortable investing broadly overseas. Although I've just given you 2 examples of companies I am invested in, but my preference really is to be able to look them in the eye and almost pick out the businesses that are going to be the next great high profit margin, high return on capital businesses, those that are at the tipping point and likely to go on to become those bigger businesses and more successful businesses. And
what time frame are you looking to buy in for? How quickly do you want to return? And then how long are you looking to hold?
Oh, well, I can wait about 24 hours for a return. No, I never really think of it in that way. So I never think about how long I'm going to be in something for. I've been in things 8, 9, 10 years. As long as the story hasn't changed, as long as the business economics haven't changed, then I'm quite happy to hold. And there may be periods when the valuation becomes stretched, and that's fine. I might take some profit. It partly depends on how much of it I've got in my portfolio. But I tend to, I'm always focused really on, can this business multiply itself a number of times? That's what I'm minded of. I don't really worry about timescale. I'm not a private equity house. I don't have to return the cash after 5 years or 3 years, So, but I am looking in terms of multiplying my money, and I don't really set a hard measure. That said, I set personal measures, So I think since 2009, I've had 16 lots of hurdles, which I keep having to update because I keep going through them. So that might be for money in my ISA, value of my SIP, and various other number of shares worth more than X in my portfolio. So I'll tend to motivate myself in that way, but I don't set any criteria for a specific stock other than the fact that I would like it to be a multi-bagger over time.
And what makes you sell?
Well, if it becomes too large in my portfolio,
But what happens if you still think all the criteria apply?
it's in those circumstances very, very difficult. And there's a case recently where I did sell at a high price and couldn't help, after meeting management again after the results was released, of coming back in to the same high level, albeit at a lower price. The trigger points really are a change in the story. If the story has changed, if growth has slowed significantly, if management changes and I don't like the new management, and if I'm owning a company and issues a profits warning, I'm pretty ruthless at getting out.
What happens if your position's very large? Can you get out?
Well, no, you can't. And generally, that's why I look for my larger positions to have more limited downside risk. So I don't want to wake up one day and find out, the company's suspended its listing. I want to be able to sleep peacefully at night. So there's ironically potentially more valuation risk in my top 10 than there is business risk, because I think the businesses I own should go on to do better. I mean, Bioventix is a significant holding, but I can be confident that over the next, that in 5 years' time, its earnings will be significantly higher than they are today. Irrespective of whether we have a recession in the meantime. I can't say that about every stock that I own, but that's certainly in my larger positions. I don't want there to be huge amounts of business risk. I'll take some, but it depends on the price I have to pay for that. I don't want to pay a high price for a lot of business risk. I want to pay a more sensible price, so I'm going to have to accept a degree of business risk.
So profit warning is pretty easy to spot, but sometimes the decision to sell isn't quite so black and white. What else would trigger you to sell, or give an example of a recent sell that you got totally out of position?
Well, I'm not. I probably can't do that because I haven't wholly sold out of it, and in fact, I'm not even sure whether I want to wholly sell out of it. But there was a stock that I had in my top 5 where I just became a bit less confident about its ability to grow and grow and grow, and I have sold probably a third of it, and it's now out of my top 10, and I'll hang around for another set of results.
And what's changed? The revenue picture, the profit picture, the margin picture?
Well, in that case, it was a poor, well, what I judged to be a poor half year relative to its valuation. Okay. Everything's relative to its, relative to the price you have to pay for it. And I wasn't sure whether it was just a one-off slowish half, and whether momentum. It's a business that's undergoing some change at the moment. But I was drawn to an aspect of the business that has high operational gearing. I think the story is still intact, but I just wanted to de-risk slightly. And, it could be that I end up having to pay a higher price to get back in, but I just felt that it was the right decision. But to be honest with you, generally speaking, when I sell, it will be triggered by a profits warning, and the profits warning generally happen outside of my top 10. So it's in those smaller positions that I'm starting researching, etc., building some confidence around. That tends to be where I have more trouble. It's with the infants and the juniors, and I've managed to avoid too many mistakes in my bigger positions.
I was interested to see in your latest piece in ShareSock's newsletter that you talked about Cloudcall and PV Crystalox, and I looked at them and thought, why, knowing your criteria, are you interested in those two?
And sometimes I ask the same question. So I'll take them in turn. I mean, PV Crystalox I bought in initially at 8p, and then a lot of shares at 10p. I think they're 26 at the moment. But it was on a very specific story. It was a company in the solar panel industry, in wind down, with two very big liabilities. These were polysilicon contracts that had been negotiated at the top of the market, and where they were contractually committed to buying both volume and at a certain price. And one big potential asset, which took the form of a contract a company had with it, which was again negotiated at the peak of the market for various wafers at much higher prices. I judge management, I see it as an asymmetric return, risk and return opportunity. So I've always been aware that I could take a 20% loss to the downside, but I always thought the upside potential could be 2 or 3-fold increase. And the story has changed there. So management have been remarkably adept at negotiating themselves out from the hangman's noose. And they managed to get themselves out of the 2 polysilicon contracts, which I think partly has been recognised in the share price. The share price has been very strong because of that. And there's underlying assets there of about 17 or 18 pence. Now they have a claim against, which could be a multiple of the company's market cap, or certainly as it was when it made that announcement and used those words. Even if that claim doesn't succeed, then I've even from the current share price, I'm sort of at risk 20 or 30%, but I'm quids in from the original investment. But I tend to I always mark to market. So my view would be that I would be losing 30%, but I'm prepared to run that risk of losing 30% because I still think that the claim could be quite significant, and therefore there could still be further upside. I think it all will come to a head in the next few weeks because the arbitration case the results should be announced imminently. Cloudcall was a company I saw back in 2014. I saw them down at ShareSoc in Brighton, and I couldn't help but be drawn to its CEO, Simon Cleaver's very enthusiastic, open nature. But I just felt at the time that it was a tiddler. Its revenues were growing very strongly, but its market cap had gone crazy. I think the shares went up from 150 to over £3 at that time. And yet the company was still very small, and I felt unfocused. It was just a sense I had. So I avoided it. And then earlier this year, I met Simon at the Senkos forum they have in January for IT companies. And I liked what he had to say, and I thought that the business had become a lot more focused. They'd had Peter Simmons join them from Dot Digital, who'd built up that business successfully, and he's a very down-to-earth manager and very focused. He'd done wonders with Dot Digital, and I thought he'd be a good influence on the company. And so I bought a position at around 70 pence. I bought more shares in the low hundreds, and then I met them more recently, just before the placing. And they seem to be on a journey, and they've learnt a lot how to do what they do better, focusing on and being more focused at it, and delivering and growing in a more measured way. That said, the company, since I wrote an article for ShareSoc a month or two ago, announced a very big placing of about 5 million, which I'd assumed it would be about 3 million, and it's larger than I anticipated. And it does worry me a little bit that the hair has been let out. And I rather like the tortoise strategy because I could see we were getting somewhere in a measured way. So, I did take part, that said, in the placing at 143. I think the shares are up since then. It's a business that has great operational gearing. And so once they move beyond a certain point in terms of the number of clients and signed up customers and users, is the specific KPI that they look at. I think there are around 20,000 users. They get to 28,000 on the old cost base. They break even. I don't know what it is since the 5.5 million raise and the acceleration that they're talking about. But once they get to there, then a lot of the profits will drop to the bottom line. And I think that could be a business doing 20%, 30% type operating margins.
And you think they've got
on a relatively light capital base. So I think that my issues there are all around management and focus, and I think I'm relatively confident they get there, but it's one of the riskier ones that I hold.
You are a graduate of economics. You're a chartered accountant. You've got a corporate finance company. For the retail investor that doesn't have that background and doesn't have that experience, can they achieve 44% per annum? Or your 19.5% per annum?
Yeah.
Compounded?
Well, thankfully, I know lots of accountants who are rubbish investors. And I'm sure there's quite a lot of economists who are rubbish investors as well. So I think there is hope. I think that private investors, they do need to develop a certain level of knowledge, and I think going to events and learning, even paying to improve their knowledge is worthwhile. It always surprises me how someone will be reluctant to go on a course for £500 or £1,000, but be prepared to lose a six-figure sum on an investment. Why learn the expensive and hard and painful way? Why not learn a low-cost way? But people hate committing that money up front. So I think there's a training thing. But I think that in the end, there are shortcuts. I tend to focus when I'm time pressured on the cash flow statement, and that is a massive shortcut for me. And I think that there's a lot of things that a private investor can bring to the table that I can't. So for instance, they may have had a career in a particular area. They may be an engineer or a software designer or something like that, or been in the biotech space. So that they're bringing a lot of expertise. And I think that they can use that expertise profitably. And I think if they've got any sense or ability to judge people, then I think trying to get in front of management helps. And there's loads of organisations that do it. I mean, ShareSoc organise monthly events in London, Leeds, Manchester. And that's a great way not only of meeting the companies and the management teams, but also, I think probably most importantly, meeting other private investors. And I think that my returns have improved significantly since I started mixing with other good private investors. Because I might have a particular bent in my mind towards analysis and numbers and being perceptive, but I may lack technical knowledge. And by being able to discuss that with other people, we all end up making a better decision as a result of it. So I think people can do, whether they can do 44%, I don't know. I'm sure many can do better, and I'm sure I won't be doing 44% next year. But one thing I do believe in is that the average private investor can outperform a fund manager. I think a fund manager has so many constraints that it's like running in the Grand National with a horse with three legs. I think they've got regulatory constraints, which means cost, which is a drag for investors. They often have to own very large portfolios, particularly in small cap funds, because otherwise they just can't get their money in and they can't grow the assets under management. They can't hold big positions. The regulations prevent them owning more than, I think, is it 9 or 10% of it in a particular company. So really, they are, and it's, when they go to a party, they have to drag a hell of a lot of people along with them. All of the people invested in their fund. So I think there's lots of reasons why fund managers actually struggle to beat the index, and in fact very few do. Only a third of managers beat the index each year, and that's partly because of costs. And I think that as a private investor, as long as you're disciplined and you don't get carried away, then I think you've got a good chance of beating the index. And certainly amongst my investor friends, generally we are beating the index year in, year out. I'm not saying every year, but certainly take a 5-year period or a 10-year period. I mean, since I've set up my ISA up 25 years ago, I think maybe 5 or 6 times I've underperformed the index, but on a 5-year rolling period, I've beaten the index every period. I think it's partly impressive, but also I think it's just the way the institutional investment community is set up means that you're never ever you're going to struggle to get the great performance there. That said, there's some excellent funds, and I don't mind mentioning those that I benchmark myself against. There's Fund Smith, there's Mark Slater, who I really rate, Nick Train, there's the Lion Trust funds. There are some really good managers out there, and if you do want a bit of a holiday and not tax yourself too much, they're good places to put your money. But if you're minded to make money and outperform, then I think, and if you find it interesting and stimulating, which I do, then I think that there's nothing better than to do it yourself.
But it is very time consuming. I mean, how long would you take researching one share before you buy it?
Well, it is time consuming, but again, if you mix with a group of other investors, that can save time, so someone else can bring the idea to you. It's difficult to know how long I might spend on a particular share. The initial investment may be made, after just a few hours. That said, there's some research that shows that the more data points you look at may give you more confidence, but it doesn't improve the accuracy of the decision. And often your first thoughts about cash flow generation, returns on capital, honesty and integrity and quality of management, those first thoughts will often be sufficient for you to make the right decision in the majority of times. And if you run your profits and cut your losses, you can't but help end up making money.
So for people that haven't got the time to do this, would you ever think of starting a fund?
Well, it's funny you should say that, because I have been approached this year, and I haven't finally made my mind up. But I've got to think about lifestyle issues, and and I'm not 55 years old now, and it takes 5 years really for a fund to gain real momentum and to start attracting a decent following. So I'll be 60 by then. I mean, my friend Keith Ashworth-Lord at Buffettology, he started at 55 and his fund's doing brilliantly. And he's now...
Buffett made most of his money after he was 60, didn't he?
Well, that's right. And but I think the other part of me thinks, well, I've got enough of a capital base now that I can carry on doing it on my own with my in a slightly more relaxed way, because I'm not accountable to anybody other than my wife, my children, and our pet dog. And I can grow my own money, and as you said, Buffett made, I think it was about 95% of his money has come after the age of 65, and I'm still got 10 years to go before that. So that gives me some encouragement. So I haven't made my mind up yet, but at the moment I'm probably leaning towards continuing what I'm doing.
And would it put you off? I mean, the things that you say about a fund, in that it being, less easy to do quick trades and to be more flexible that you can as a private investor.
Yes, I mean, so we might be sitting here, if I was a fund manager, and you might be saying, well, Leon, you've done 14% this year, not 44%. So that could be that's inevitably a factor, because there has to be a drag. I can take a big position in a small company. A fund manager can't do that very easily, and if they do, they end up arriving late to the party and having to overpay to get into. We've seen that with companies like Acesso, where it was initially private investors when it was low Q, and even when it converted to Acesso. But the real growth in the share price has come as bigger institutions have become aware of the story and come in at a much higher price. And then, of course, if I do make a mistake, I can often call up my broker and I'll be out the next morning. A fund manager can't do that. He has to do it very gradually. And in some ways, in small cap, once you've committed, it's very, very hard to get out. And so it's a decision that you have to do a lot more due diligence if that's the case. And you can't let the passage of time help you guide whether you've made the right decision, because often I'll carry on buying, reinforced by my story being verified by events. Whereas for fund managers, they have to take an all-in bet up front, and they can't really do much, particularly the small cap space. They can't really do very much to flex that position over time.
Although coming in from a private investor perspective, you might buck the trend, because most fund managers have come in from a professional perspective and they've never done it themselves for themselves. Yeah. So you could be the Warren Buffett of the UK.
Oh, you're very kind, Tamzin. But certainly the corporate finance angle helps, because I've actually been involved in companies that, and seen how private companies work and how they've grown, etc. So, and negotiated deals, and all that helps, I'm sure. I think it's likely that if you interview me again next year, that I'll still be a private investor, and let's hope I've not lost too much money by then.
Well, you might have made 88% next year.
Well.
Leon, thank you very much for your time. It's been lovely to speak to you.
Thank you very much.